Hey, good morning, my friends. It's Hammer. Today is Thursday, February 8th, 2024. I, of course, am with Originator Success here with your daily mortgage rate update, the only place on the web where you guys get to be a part of the conversation and join me live each and every day. Remember, you can join me at 9:30 a.m. Eastern time as I do these videos. If you are watching live, say good morning. Let me know that you were here. Make sure you participate. Always appreciate that. It's why I do this for free each and every day, just to hear from you. If you're watching on the replay, don't forget to give me a hashtag replay in the comments, whether you're watching on Facebook or on YouTube. I do appreciate that. It lets me know that you're watching and where you're watching. Don't forget to smash that like button. If you're on Facebook, tag an LO friend, share this post in a group. Appreciate you doing that. Appreciate Mr. Michael Fisher for doing that as well. Thank you, sir. I appreciate that. If you're on YouTube, don't forget to give us that thumbs up and subscribe and all that stuff. You know how it goes. So anyway, what do we got going on this morning, y'all? Well, rate sheets today are losing ground after bonds slipped this morning. Let me go ahead and show you a little bit here. You could see yesterday morning, this line chart, we were up higher, which helps mortgage rates. As this line goes down, we actually lose ground. That's bad for mortgage rates. We didn't lose enough ground during the day to really cause a lot of reprices worse. There were, a couple of the wholesale lenders that love to pull a trigger when things move, even a mouse fart, but really not much of a move. But this morning, you can see that moves also a little bit lower. If we look at this in the spectrum of a 5-day line chart, kind of tells a little bit of a clearer story. So this, of course, was on Groundhog Day, a day I don't want to relive. That was when we lost ground due to all of the jobs data. So big loss, more big losses, kind of a recovery. Then we had Monday, another big loss here as we just saw markets shift. We could blame it on Fed Chair Jerome Powell's 60 Minutes interview or not, but it was the last these couple of days we were up here. And then Friday and Monday, we were all the way down here. Now, Tuesday, we started to recover and we saw that rebound, which I was very happy to see. Yesterday, that started to lose ground. And what that tells us when we that Tuesday's improvement was not really a sign of a rebound. It was more of a buying opportunity. So this morning, you could see rates will be a little bit worse. As we've lose ground this morning, we're down right now about 17 basis points, which basically it's more of just a pricing change than it is a rate change, but it's still not all that great. Reprice risk on the day is low, though. We only have the 30-year bond auction this afternoon, but we could see bonds creep worse through the day like they did yesterday. See here how we kind of lost ground through the day. That may happen again today, but I don't anticipate that the 30-year bond auction will be a big deal. One of the things that's kind of cool, though, is that the bond auction is 3 for 3. So here's the Bloomberg 5 things to start your day. Another bond test. U.S. Treasury will complete its quarterly debt refunding today with the sale of $25 billion of the 30-year bonds. The sale of the longer maturity notes is this week's third test of investor confidence. The market's ability to absorb supply. We've had record supply this quarter, following the successful sales of 3 and 10-year bonds the past few days, which have had a very good appetite, and that's a great sign. The strong demand shows the primary market is resilient to fears around the commercial real estate sector following the New York Community Bancorp's downward spiral in the equity market, and investors are also absorbing a run of warnings from Fed Reserve policymakers, all those Fed members out there shaking the trees, saying that a rate cut isn't going to happen until as likely as May. So that puts us in a position where we want to go ahead and continue to cautiously float. We may want to consider locking loans closing in the near term in the next couple of weeks. Here's why. Next week, we get the inflation data, and that's going to be the big thing that we're looking at to figure out if we are going to see improvement in rates, right? So I'll jump over that in a minute, but basically, what I want to do now is I want to say hi to all my friends. So let's say hi to the live folks that are here this morning because I dove right in. So we've got Mallory Fodiatis. Good morning, Mallory. Scott Minster, sir. Great to see you. Tim Klyla. Great to see you as well. Bobby Searson. We've got a Facebook user, which I think maybe Deb Dickinson. I should probably take a look here. You know what? Let me go ahead and I'm going to look and see who is our Facebook user. It looks like that is Deb Dickinson. Good morning, Deb. Great to see you. Let's see who else we got here this morning. We've got Ron Siegel, Candido Diaz. Great to see you all. Mike Morano, Michael Love, Michael McAllister. Look at all those Mike and Michaels all in a row. We got Tom Dedmore. Good morning, sir. Chris Montgomery, Cindy Pulliam. Great to see you as well. So, all right. I want to talk about the CPI inflation report. So basically, here's what we got going on. If I kind of get rid of some of that stuff, mortgage rates, let me pull up the Mortgage News Daily and we'll look at this together here and we'll kind of talk about this. So looking over here, Mortgage News Daily, that's got rates at 6.95. Now, the best that we saw right here, 6.63, this came immediately after the Fed meeting and press conference on that Thursday. So on January 31st, it was a Wednesday, Fed Chair Jerome Powell got out there, he did his press conference, and the next day we saw some of the best rates that we've seen. Let's call it 5 5/8, right? Or I'm sorry, 6 5/8. However, then we had labor market data on Friday, and that's where, again, I take ownership. I screwed the pooch on that one. I figured we would flow through, and it shouldn't be a big deal. The previous month, we got a strong report. Things reacted poorly, and then an hour later, it was like it never happened, right? I expected that to happen again. Instead, what happened was I did not account for the change in seasonal factors, the way they were going to change for seasonal adjustments, and all of a sudden, what probably would have been just a regular strong jobs report came in at a ridiculously strong jobs report. So instead of 180 or 170, 180,000 new jobs created, we came in with a number of 353,000. Now, as we've talked about many, many times, these numbers are basically made up. I don't want to say they're just like written out of thin air, but when you do all these seasonal adjustments, as Ron Siegel pointed out, as a couple of others, I think Mike Thibault pointed it out, as you look at this, it actually made a difference of over 150,000, maybe 200,000 jobs. And that's what gave us this ridiculous report. Well, we have that same thing happening on the CPI report next week. February CPI, but it's actually January's numbers. And they're introducing new seasonal factors. Now, here is an article. Waller, Fed Governor Waller, who is a voting member on the Fed, and he spotlighted the annual updates to the CPI seasonal factors. And he actually talked about them. And he said, recall that a year ago, when it looked like inflation was coming down quickly, the annual update to the seasonal factors erased those gains. My hope is the revisions confirm the progress we have seen, but good policy is based on data, not hope. The Bureau of Labor Statistics regularly adjusts monthly CPI data to remove seasonal factors that affect the numbers. Those might include, for example, things like estimated impact of harvests or trends related to holiday shopping. Smoothing through these with seasonal adjustments makes it possible to meaningfully compare inflation. What this really says is that they make this shit up. Let's just call it what it is. This is just manipulated data. And I don't know who gets to manipulate the data, but I know that if we get good inflation data next week, then rates are going to come back down. And we'll see, mortgage rates come back down into that 6 3/4, 6 5/8. We need to see signs of positive inflation, cooling inflation, right? However, if these seasonal adjustments, if we get a wonky reading, well, now we're going to add insult to injury. And what's happened here is, remember, we went from seeing the best mortgage rates when the Fed futures pointed to a March rate cut. Now, the Fed members have always been saying that they're not going to cut in March, but the markets were ignoring that. And markets were basically betting on, hey, the data is going to support that you need to start cutting. And instead, we've seen super strong labor data, super strong economic data, even though we've talked about this all many times, that underneath, it's really not as strong as it looks. But on paper, on data, especially because it's all manipulated, we're seeing super strong data. So the chances of a March rate cut are down to less than 15% or about 15%, right? 17%. And because of that, when we look at mortgage rates, we see mortgage rates that are higher. That's just, it's cause and effect, the expectation of that cut. Now, we aren't going to see any miraculous expectation of a March rate cut. However, markets are looking at May. this May number keeps going up and down between 30 and 40% of whether it will stay the same. So the 60 to 70% expectation of a rate cut. Now, this is May 1st. Today's February 8th. That's February to March, March to April, April to May. That's 3 months away. We're going to see this continue to fluctuate up and down based on how all these different reports and how this data comes in. Now, in the near term, over the next couple of weeks, if we do not get a favorable reading in that inflation data next week, we're going to see rates get their butts kicked. They're going to go higher. So that puts us in a position that if you see rates that are, if you've got loans that are closing in the next couple of weeks, you've got to decide, again, with the consumer, of course, are we going to risk next week's data? Now, here's the problem. If you lock in now and next week's data does come in better, we're going to see rates drop and then it's going to suck. But if we don't lock in now and the data comes in higher and rates creep higher, well, then that's going to suck. So this kind of a position is just one where it sucks. We don't have a crystal ball. We don't know what's going to happen. I want to see better CPI inflation data. Will we see it? I don't know, especially with these seasonal adjustments. Now, the seasonal adjustments don't mean that the data has to come in crummy. It really doesn't. It just means that it can. All right. So there's a lot of variation coming in. And then on top of that, next week's brings actually some more data. Let me make this a little smaller so we can look at. There it is. Okay. So no, I don't want that. I want the, hold on a minute. Here we go. Economic calendar. All right. So let me put this back on. Bloop. Okay. So, and make it a little bigger so we can actually read it. Can I move this? Yeah. All right. So next week, hold on. I got to make this so I can see it. Next week. Here we go. Okay. So next week, as I play with these screens, we've got CPI comes out on Tuesday, right? Consumer Price Index. We've got Producer Price Index on Wednesday. And then Thursday, we're going to have retail sales. That's going to be a big economic report. Why does the producer prices come out? No, they should come out the day after. It's usually the CPI and then the PPI. I'm not seeing PPI until Friday. So, okay, well, it's going to be a couple of days later. So we've got CPI coming out on Tuesday, and I'm not quite sure why this is scheduled for Friday, but the PPI comes out on Friday. We got retail sales. Next week's going to either be a really good week for bonds and help rates improve, or it's going to be a really bad week. Now, looking at the rest of the technicals here, let me get this out of the way, and we'll kind of pull this back here. Okay, looking at the technicals. No, this doesn't want. Let me refresh it. Ron pointed out, as everybody should remember, that guidance is why the borrower needs guidance from all of y'all, mortgage professionals, which is why you're watching me today to get some guidance, and not fintech companies. This is what they can't get on their own. So for sure. By the way, well, I'll talk about it later. We'll get on that soapbox another day. Take a look here, though. We are near the same low levels that we were on Monday, and there's a support level right here where we ended the day at 99.38. Right now we're at 99.41. We're at the worst levels that we saw Monday. This sign of a recovery, this green candlestick here, basically it was a fizzle. It was just a good time to buy. After bonds lost as much ground, that was a buying opportunity, and then they lost some more ground. What this tells us a story of is that this is where rates are likely to stay unless we get a strong showing with that inflation report next week. If we do not, we're not going to see rates improve. Looking at the 10-year Treasury yield, again, we tested 4.18. Right now, we're at 4.15. The other day, we were at 4.16. We're right at those same support levels for the 10-year Treasury yield. If we break above 4.18, it's going to be a really bad sign. If we see it go above 4.25 and that kind of a thing. So right now, again, I'm cautiously floating for what we've got going on. Loans that have time, I mean, if they're risk averse, lock them, right? I mean, that of course goes without saying, but I think what'll happen is as we get closer to the March meeting, I think the March meeting is going to help us. If we get any kind of data, if we get let's face it, we're going to get labor data revisions on March 8th. We're going to have March 8th. We're going to have new payroll data, right? And then that's a month from today. And that's going to have revisions for January's data. And they always revise it a big lower and all that stuff. And the other reality is that we're going to have another CPI report that's going to come in March. We've got a lot that's going to happen between now and that March meeting. Loans that have time, like 30 days, they're kind of in that in-betweener land because they're not going to make it there. We may see rates that are a little bit higher than where we're at today. It's not a guarantee that we're going to see things improve. However, loans that have more time as we get to that March, I think then we start to see rates come back down again. So we will be talking rates are going to come down this year. They're going to move lower, but they may creep higher before they go lower. We know that it happens. It's happened before. It'll happen again. Right now, we've seen them right around. Look at where we spent the last 30 days. It's been anywhere from 6 5/8 to 7%. Most of the time between 6 5/8 and 6 7/8. That's within a quarter point range for rates. That's actually not that bad. Consumers are getting used to these fluctuations. They're getting back off the couch and getting back into the market. So good things there. Mike Morano sharing some stuff on there. Let's take a look and see what Mike was posting. Mike said, investors are almost always wrong about the Fed. And I don't get the link that I can post it here. So, but Fed interest rates, I have the Wall Street Journal. I just don't know what article that is. But yeah, I mean, because I agree with you. It's there. Ron said jobs report comes out the day after the State of the Union, so that will provide cover for big revisions as the news will be covering State of the Union and ignore jobs. Not that I'm a conspiracy theorist. Yeah, no, but Ron, you're right on a lot of your stuff, man. You're a smart guy, so I love listening to what you bring to the table, and thank you for sharing that with us. Each day when you join us. So anyway, my friends, we're at 17 minutes. I'm going to wrap it up. I haven't told you in a while. Remember, you can sign up for our written lock advice. I send an email out each and every day. www.ratelockedvice.com, or you can use this cool QR code. Remember, if you want to sign up for our text alerts, they're $7 a month. We send out a morning text, an afternoon text, and then if there's likelihood of a reprice worse, we send that out and warn you so you can protect your pipeline. Check those out at ratetextalerts.com. Last but not least, check us out at originatorssuccess.com. Although I love chatting with you about rates and pricing each and every day, what we help you do is get loans from Google and social media. We've got review software. We've got email campaigns that go out automatically. A lot of wicked stuff. Go check it out. And if you'd like a text reminder to be on today's call every day that I do at 9:30 a.m., you can click here. This is free. This is for a free text reminder that I'm going live. If you want to get a reminder, get the link to your phone so you can just pop on. That way you don't have to depend on Facebook or YouTube to tell you that I'm live, or you don't have to remember that it's whatever it is in your time zone, but 9:30 Eastern. I send out a text alert right as I'm going live so you can hop on as well. So that's it, my friends. I hope you all have a fantastic day. I appreciate you, and I'll see you tomorrow. Bye-bye.